All right, welcome to The Explainer. Today we're going to tear apart the world's most popular and maybe most misunderstood financial metric, the price-to-earnings ratio.
Okay, let's just dive right in. I mean, everybody uses the PE ratio, right? From Wall Street pros to someone just dipping their toes into investing. It's the go-to number to get a quick read on a stock. But what is it really telling us? Are we even talking about the same thing when we use it?
You know, finance professor Aswath Damodaran absolutely nails it with this quote. Behind that one simple number, you're making all these hidden assumptions about how fast a company will grow, how risky it is, and that's the dangerous part, right? When those assumptions are just kind of hiding under the surface, that's when you can get burned. So today, we're going to drag them out into the open.
So right off the bat, you got to understand this. The PE ratio isn't just one single universal number. It sounds so simple, but as you're about to see, the devil is seriously in the details.
And this slide really lays it bare. The P, the price, that's the easy part. It's just what the stock is trading for right now. Simple. But the E for earnings, oh man, that's where the rabbit hole really begins.
So you see, the E could be, well, it could be last year's earnings or the last 12 months, or what some analysts thinks it's going to be next year. And that's before we even talk about one-time events or stock options. You could literally come up with a dozen different PE ratios for the same company at the same time, and technically, you wouldn't be wrong.
So what's the big takeaway here? It's simple, really. Before you even start arguing if a PE is high or low, you've got to make sure you and the other person are actually using the same PE. Otherwise, you're just talking past each other.
Okay, so things get even weirder when you zoom out and look at the entire market. This is not your standard bell curve from statistics class. The world of PE ratios is, well, it's seriously skewed.
And this chart just lays it all out there, doesn't it? Look at that. The vast majority of companies are all clustered down at the low end, PEs under 15. But then you get this long tail of outliers stretching way out to the right with these crazy high numbers.
And because of those crazy outliers, if you just do the simple math and calculate the average PE for all US stocks, you get this insane, totally misleading number. We're talking 80 plus. That number is basically useless for judging a normal company. But if you look at the median, the number that's smack dab in the middle of the pack, you get a much more sane, much more useful number, around 16.5. So, pro tip, whenever you're dealing with multiples like PE, forget the average. The median is where the real story is.
And if you thought that was weird, check this out. To even have a PE ratio, a company has to be making money, right? The E has to be positive. If they lose money, the PE is meaningless. Well, that one simple rule means that more than half of all publicly traded companies don't even make it into the sample.
So what? Why does that matter? It's a huge deal. This creates something called survivorship bias. We're systematically kicking out a certain kind of company, usually the younger, riskier, faster-growing ones. The sample we're left with is skewed towards the older, profitable companies, and that can totally warp how we see the market. All right, so if a PE isn't just some random number, what actually drives it? Like, why is one company trading at a PE of 10 and another one is at 40? To figure that out, we have to look under the hood of a basic valuation model.
And when you do, it really boils down to just three things. Think of these as the three hidden drivers. First, higher growth. Investors will pay more for $1 of earnings if they think those earnings are going to grow fast. Second, lower risk. Safer, more predictable companies get a higher PE. And third, higher efficiency. If a company is a cash-generating machine making great returns, it earns a higher PE.
But here's the catch, and it's a big one. These three drivers are almost always fighting with each other. It's like a constant tug of war. That super high growth company? Yeah, it's also probably way riskier. The PE ratio you see is just the final score of that battle.
Okay, so now we have this framework, and this is where it gets really powerful. We can stop just staring at a PE number in a vacuum. Instead, we can become detectives, hunting for mismatches. Companies where the PE ratio just doesn't seem to line up with its fundamentals.
So here's what we're looking for. This is the profile of a potential bargain. Yeah, we want a low PE, but that's just the start. The real magic is finding a low PE that also has high growth, low risk, and great returns. We're looking for a low PE that has no business being that low.
Okay, let's look at a real-world case study. We're going to hop in the time machine back to 1999. You're looking at a list of global telecom companies, and one just leaps off the page, right? Telebras from Brazil. Its PE is just 8.9.
I mean, that's way, way cheaper than everybody else.
So naturally, the first thing you're thinking is this it? Is this the hidden gem? Is this a huge bargain the market has just totally missed? Or is something else going on?
So let's use our new framework. Let's look at those hidden drivers. And right away, a couple of red flags pop up. First, look at its growth rate. It's lower than most of its peers. And second, its risk. It's operating in Brazil, which back in 1999 was considered a much riskier emerging market than a place like, say, Denmark.
So what happens if we actually account for that stuff? We can run a little analysis that basically says, okay, for a company with this level of growth and this level of risk, what should its PE be? And look at the result. The model spits out a predicted PE of 8.3, which is almost exactly what its actual PE was.
And boom, there's the big reveal. Telebras wasn't cheap. It deserved to be cheap. It wasn't some undiscovered bargain. The market was actually being pretty smart, pricing in that lower growth and higher risk perfectly.
And that really brings us to the single most important takeaway of this whole thing. A low PE ratio is not the end of your research. It's the absolute beginning. It's the starting gun. It's the clue that makes you ask the most important question: why?
So this is the mental model you can take with you. The next time you're scrolling through stocks and you see that super tempting single-digit PE, you'll know what to do. You'll stop and ask the right questions about growth, risk, and efficiency. And you'll be able to figure out for yourself, are you looking at a true bargain or just a trap?